Institutional investors, such as pension funds, mutual funds, and hedge funds, have a fiduciary obligation to recover assets lost as a result of business mismanagement and/or fraud through investments in public securities. Class action litigation, which pays out billions of dollars to deceived investors each year, is frequently used to recoup these losses. When these disagreements are resolved, institutional investors usually believe that their custodian will participate and recover the assets on their behalf, just like a regular corporate event such as a dividend. Unfortunately, this service is not included in agreements, and the information is very opaque, with participation rates as low as 20%. Here are some reasons why you should not depend on brokers and/or custodians to ensure the recompense you deserve. 1. Clients may not be notified of every settlement by custodians. In a securities class action lawsuit, clients may not be notified of every settlement by custodians. When a securities class action is settled, the court nearly always requires investors to be notified of a settlement. This is usually handled by a claims administrator who sends notices to brokerage firms, banks, institutions, and other third parties who may hold stocks and street name on behalf of investors. Notices sent to a custodian bank, on the other hand, may not be received or may not be sent to the relevant person at the fund. It is possible that notice will be forwarded after the filing deadline has passed. Additionally, custodians may not have any responsibility to monitor these sources for settlement information if a party's contract does not clearly define roles. Unless a fund receives notice of a settlement, there is no way for it to claim its share of the settlement. At Qalqon, our automated system track and notify our subscribers on such claims and settlements. 2. In most cases, custodians' responsibilities are frequently unclear. A custodian bank can be utilized as a source of settlement information as well as the party and the responsibility of filing the claims during the claims filing procedure. The institutional investor, on the other hand, may miss out on settlement recovery opportunities if the custodian's position is not explicitly stated in the contract. For example, some custodians will only keep title to their clients' stocks and will not be involved in the claims filing process. These custodians would be in charge of informing their clients about class action settlements, which would very certainly include forwarding any notices received from a claims administrator. However, unless there is a contractual obligation to do so, or even have the operational expertise to perform such duties, at Qalqon, we value shareholders' rights and act in our clients' best interests. Our automated software checks and notifies our subscribers for securities class action lawsuits and notifications of settlements. Custodian banks can, of course, take on additional obligations such as checking for possible settlements involving their clients, submitting claims, or providing sufficient information to the party filing claims on behalf of the institutional investor. Sometimes, there are no clear guidelines between investors and custodians. Consequently, an institution may believe its custodian is looking out for its best interests, while the custodian believes it is under no responsibility to evaluate settlement notices. 3. Changes in custodianship might lead to missed opportunities. Many institutional investors change their custodians regularly as part of their responsibilities to examine the expenses and performance of their providers. If an institution relies on its custodian bank to collect settlement payments, a change in custodian might quickly disrupt the claim management process. This is particularly troublesome when institutional investors fail to address the responsibilities that will move from the custodian to the fund once their relationship with the custodian has terminated. A departing custodian, for example, is unlikely to send the transactional history for the portfolio it previously maintained to the institution or the next custodian. As a result, neither the successor custodian nor the institution will be able to identify whether or not they have a valid claim to submit to the claims administrator. Instead, the institution will have to rely on the information provided by its prior custodian. The previous custodian's ability to file a claim on behalf of the institution may be contingent on whether the former custodian has given the necessary transaction records. Furthermore, the former custodian of an institutional investor has limited incentive to closely monitor and pursue any claims on behalf of its former clients. 4. Custodians do not receive any compensation for filing claims. Unfortunately, a custodian bank or other intermediary has no financial incentives to make claims on its client's behalf. If a custodian is paid a set fee, but is responsible for all claim filing costs without reimbursement from the institution, as appears to be the case with institutional investors, the custodian's financial interests would have a preference not to file anything to reduce their operational burden. For institutions that rely on custodians to process corporate events and income distributions, this presents clear conflicts of interest. Furthermore, if the institution fails to adequately monitor claims submitted on its behalf, the problem may go undetected. Even the most seasoned investors will struggle to grasp the claim paperwork. They can be 10 or more pages long, with specific instructions requiring the claimant to keep track of all of her relevant securities transactions during the class period, including dates and buy or sell prices. If the claimant purchased stock from the issuer in both the primary and secondary markets, those transactions may need to be listed separately. Claims must also include documentation for all transactions stated and, under penalty of perjury, affirming that the claim information is correct. At Qalqon, our automated fintech software, together with our affiliate law firms, we are the best alternative in making the entire front-to-back claim process transparent, simple, and ensures you receive the returns you deserve. 5. Institutional investors have little recourse against custodians. Despite the fact that custodian banks have fiduciary duties to their client money, institutional investors may have little recourse if their custodian fails to notify them of a settlement. The institution would unwittingly miss out, which impacts their fund's performance. 6. Institutional investors must keep a careful eye on custodian banks. While relying on custodian banks to collect settlement payments carries risks, institutions or individual investors that do so should conduct regular monitoring efforts to ensure that the custodians are performing their duties, either through periodic audits or by hiring an independent third party such as Qalqon, with experience to do so. This would not only raise the amount of money the institution receives from class action settlements, but it would also potentially shield the trustees and management from culpability. Alternatively, investors of all kinds could look to Qalqon to provide the solution. In summary, if your stock or shares are experiencing unusual fluctuations, such as abrupt up or down movements, this could be a symptom of stock manipulation or fraud and mismanagement if it is decreasing. At Qalqon, we collaborate with law firms, banks, fund managers, insurance companies, hedge funds, custodians, finance professionals, individual investors, and academics globally. Our automated front-to-back software solutions together with our team of professionals will ensure the returns that you deserve and that shareholders' rights are fully enforced. Thank you for taking the time to learn more about Qalqon and why you should not totally depend on custodians and brokers. Please feel free to contact us on any questions you have on your investment performance. We congratulate you in advance on your stock market accomplishment.